Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing onsemi stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 24 billion market cap. They're trading at $55 a share, and they have 427 million shares outstanding. onsemi is a supplier of power semiconductors and sensors focused on the automotive and industrial markets. It is the largest supplier of image sensors for the auto market. The company was incorporated in 1992, headquartered in Scottsdale, Arizona. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow peaked in 2022 at 1.6 billion. Then it came way down to 400 million in 2023. But it jumped up a lot into the trailing 12 months, almost 1 billion, up 150% from 2023. And their margins are 14%. It was as high as 19% in 21 and 22. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that doubles from 2021 to 2023, 2.2 billion. It came down in the trailing 12 months to 1.8 billion. And margins a little stronger for net income, 24% in the trailing 12 months. Revenue is sales for the company, and that peaks in 2022, but then it goes down after that. How could a semiconductor company have declining revenue in 23 and 24? It just doesn't make sense. We estimated 4 years of future free cash flows. We also estimated a terminal value of all cash flows past year 4, that's 55 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $47 billion. We divide that by 427 million shares. And we get a calculated stock price of 110. They're trading at 55, so they're trading at a 50% discount. It's a really strong buy according to the model. This might be the only semiconductor stock that's undervalued. There are 64 companies in the same industry as onsemi, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spent 921 million in capex. These are the investments in property, plant, and equipment. Their debt to equity ratio is equal to the average 0.4. They don't pay a dividend. They generate 1 billion of free cash flow, lower than the median average. They rank 15th in market cap at 24 billion, pretty similar to Global Foundries and ST Microelectronics. And look at these price multiples. They're trading at below 3 times book value, 13 times earnings, 24 times free cash flow, and 3 times revenue. Really impressive multiples. They generate 7.4 billion of revenue, which is double ARM. And ARM is 175 billion market cap. Their revenue growth isn't so strong. The 5-year annual revenue growth rate is only 6%, which is lower than the median average. The stock is $55 a share, which is only 5% away from its 52-week low, 32% below its 52-week high. It could be a good time to get in. If you put $10,000 into this company 10 years ago, at the peak in 2021, you would have been close to 90,000. But it has come down since then. Your 10,000 will be 54,000. Still a really good return. To summarize, I have them trading at a 50% discount, ranking 7 out of 10. It does look like a really good value. Short term, I would definitely buy it 8 out of 10. Long term, I think it's okay, but I'm kind of questioning why they've been struggling lately. And they have great ratios. One of the better ones of the semiconductor companies, 8 out of 10. Financials aren't so great because their revenue is only up 9% since 2021. And free cash flow is down 23% since 2021. Let's take a look at their income statement. Here's the third quarter of 24, third quarter of 23. Revenue is down 2.2 billion and 1.8 billion. Things are not looking good. Let's see if they give a breakdown of the revenue. Here's a breakdown of the revenue. Power Solutions Group, 829 million. Analog and Mixed Signal Group, 650 million. Intelligent Sensing Group, 279 million. They also show the gross profit. So it looks like margins are pretty good in each industry because they have positive gross profit in all three. Their gross profit is 799 million. Here's a different breakdown of the revenue. Of the 1.8 billion, they have 466 million in Hong Kong, 449 million in Singapore, UK 400 million, US 280 million, all other 168 million. And they give a breakdown by each business group for the country. Of the 1.8 billion of revenue, 1 billion is through distributors, So they sell to distributors, and distributors sell to the end customer. 765 million direct to customers. That's much higher margin, the direct to customers. A bulk of their revenue is automotive, 950 million. They sell semiconductor chips that go into those cars. Industrial, 440 million. Industrial usually means factories, warehouses, things like that. Then you have other, 371 million. They do footnote other. Other includes the end markets for computing, consumer, networking, and communications. They also give a breakdown for other product technology. 914 million intelligent power, 344 million intelligent sensing, other 500 million. So revenue is down 19% year over year. They have one customer whose revenue accounts for 12% of their total revenue. I wonder if that's Amazon. Just a guess. If you know, let me know in the comments. Let's go back to the income statement. Below revenue is cost of revenue. These are all the expenses directly related to generating revenue, 960 million. Gross profit, 800 million. So gross margin's a bit over 50%. Here's their gross margin, 45%. It's down from 47%. Usually if revenue goes down, so do margins. They have their highest gross profit in AMG, almost 50%. The lowest is PSG, 42%. Below gross profit is operating expenses, R&D, 150 million. Selling and marketing, 65 million. G&A, 95 million. And then there's amortization or restructuring. So their operating expenses, 350 million. Operating income, 445 million. Let's see if they provide the margin for that. I don't see the margin. This is just a different income statement. They spent 15 million of interest on their debt. They received 29 million of interest income. So their pre-tax income, 450 million, 50 million of taxes, a lot less than last year. Last year was 114 million. So net income, 400 million, which of course is down from last year. Their EPS is 94 cents. Last year, $1.35. Shares outstanding went down about 4 million, 431 million to 427 million. Let's look at a balance sheet. Their current assets, 6.5 billion. Current liabilities, 2.1 billion. So a really high current ratio, about a 3. They have a lot of cash, $2.5 billion of cash. Their biggest asset is PP&E, 4.4 billion. Let's see if they give a breakdown of that. Here's the PP&E by country. South Korea and US, about 1.4 billion. That leads the way. So if they have a factory in South Korea, that's part of their PP&E. Or if they have equipment in a factory in the US, the value of that equipment is part of US. Czech Republic is third, 600 million. That's surprising. I didn't think Czech Republic would be that high on the list. China, Philippines, Malaysia, Vietnam, and other. Their total assets, 14 billion. Last year was 13 billion. They do have a lot of goodwill, 1.6 billion. Let's see if they give some info on that. They do give a breakdown of the goodwill by segment. AMG is the most, 813 million, then PSG, then their ISG segment. This is the original goodwill, 2.4 billion. They took impairments, 780 million of impairments, and they did a reallocation. They moved 25.9 million between these two groups. It looks like they added 10 million of goodwill in the first 9 months of 2024. Addition to business acquisition, 10.3 million. I wonder if they give more information, like which companies they acquired, or company. I can't really find it in here. Liabilities, 5.3 billion. Last year was 5.4 billion. Their biggest liability by far is long-term debt, 2.5 billion. Here's some more info on the long-term debt. 1.5 billion at a really low interest rate, 0.5%. 800 million at a 0% interest rate. This must be convertible debt. Assets minus liabilities equals equity, 8.6 billion of equity. They raised 5.3 billion from selling their business. They profited 7.7 billion from running their business, and they buy back a lot of stock, 4.4 billion. If you want to learn more about the equity section, you could look at the report, the Statement of Stockholders' Equity. In June of 2024, their equity was 4.23 billion. They paid 3 million of taxes on RSUs, restricted stock units. They bought back 200 million of their stock, so that brought it from 4.2 billion to 4.4 billion. In December 2023, it was 3.9 billion. They paid 48 million of taxes on RSUs. They bought back 450 million of stock, so that brought it to 4.4 billion. Oh, it just matches this. It's just a different way to look at it. This top part is just for the quarter. This bottom part is for the trailing 9 months. Let's look at a statement of cash flows. This is the trailing 9 months. Operating cash flow $1.3 billion, pretty similar to last year. In their investing section, they had a cash outflow of $858 million, $550 million of PP&E, and then this is just short-term investments, so they have somewhere to park the cash and earn some interest. In the financing section, they bought back $450 million of stock. Here's the $48 million of taxes for RSUs. They received $20 million from their employees in the employee stock purchase plan. Let's look at a company on Simply Wall Street. Its last price, 51, 22 billion market cap, down 2% in the past week, down 36% in the past year. So this stock has struggled while other semiconductors have gone up 200, 300, even 400%. It looks like they started trading in 2000, mid-2000, at about $20 a share. The dot-com crash was a year later. Also the Enron fiasco. And the stock fell to below $1, I think in 2001 sometime. It's hard to tell on this chart. Maybe in 2003. Imagine getting it below $1 and then hitting $100, 100x return. You need to sit on it for 22 years, but 100x return would be amazing. But it's hard to do that. It did run up to 27 by 2018, which is pretty close to the IPO price. So 18 years after IPO, it was flat, if you don't count dividends. And then it traded sideways over the next 2-3 years. Came down to 12 during the COVID crash. Actually, it looks like got down to 845 during the COVID crash. Then it had a really nice run up to over $100. So you could have more than 10x your investment. Of course, hindsight's 2020. And that was in August 2023, but it's come down quite a bit since then, cut in half. So it could be a good time to get in. Simply Wall Street's valuation is 176. They say the stock is 71% undervalued. 29 analysts priced this stock at 79. They say the stock is 53% undervalued. Let's look at their revenue since 2014. It was $2.8 billion, and then it doubled over the next 4 years. By 2018, it hit $5.8 billion. The peak was $8.3 billion in mid-2023, but it came down to $7.4 billion. That's the current revenue in the trailing 12 months. Here's their debt since 2014. It was $900 million. The peak was $4.7 billion. When a company takes on a lot of debt, it's usually for acquisition purposes. It's come down to $3.3 billion currently. But their equity is higher than their debt. It used to be really close. They were crisscrossing for many years. Now their equity is $8.6 billion, debt $3.3 billion. Their cash is pretty close to their debt. $2.8 billion of cash, $3.3 billion of debt. So it looks like they're pretty well funded. The CEO's salary was $36,000 in 2020. I can't believe it was that low, but now it's $1.1 million. Total compensation $20 million, 4 years as his tenure. In the past year, only insider sells, no buys. And a lot of the sells were by the CEO. You can see Hassan's name right here, 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 and here. Pretty much all the companies owned by institutions. Fidelity is the biggest shareholder at 15%, then Vanguard at 12%, JP Morgan at 2%, Capital Research 1%, and to round out the list, Van Eck at 0.8%. Their employee count was 24,500 in 2014, now it's 30,000. The peak was 36,000 in 2018. The ticker trades on the Nasdaq, Deutsche Börse, Xetra, London Stock Exchange, Mexican Bolsa, Wiener Börse, Borsa Italiana, and Sao Paulo Bolsa. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.